markets are both cyclical and volatile. Investors usually struggle to separate emotions from strategy in volatile times. To avoid this behavioral trap, it helps to know where we are in the market cycle.
So how do we do this?
Howard Marks once described markets as a pendulum that swings between extremes of optimism and pessimism. To understand where we are in the swing towards optimism or pessimism, we look at multiple indicators. A contrarian investor looks for where sentiment has pushed prices away from underlying reality and position themselves accordingly.
Okay. So this is why we are looking at two indicators today. The first shows where returns are concentrated in the larger stocks or spread across the market. The second shows which investing style is leading. So what are we measuring when we talk about market concentration?
We are comparing how an equal weighted index performs versus a market cap weighted index. In simple terms, is performance coming more from larger stocks or is it spread across all stocks? If equal weighted index underperforms market cap weighted index, it means larger stocks are driving returns and concentration is rising. If equal weight index outperforms, it suggests broader market participation.
So why does this matter for the investors?
Because it reflects market's risk appetite. When larger, more established companies are leading, investors typically are leaning towards relative safety. This points to a more cautious risk-off environment. This is a favorable environment for contrarian investors to be aggressive at the points of inflection, that is.
So moving on to the second chart. Here we are comparing Nifty 500 Momentum 50 and Nifty 500 Value 50. So what exactly are we measuring here?
We are measuring the difference in returns between the momentum index and the value index. For example, if momentum delivers 18% and value delivers 10%, the difference is 8%. This tells us that momentum has outperformed value by 8% margin. If the number is positive, momentum is leading. This usually indicates that market is heated. If it turns negative, value is leading, then there is a likelihood of momentum based opportunities in the future. So first we identify which factor is ahead, then we compare that difference to history.
Oh, so why do we have to compare it to history?
That's a good question. This is to understand if the current gap is unusually large compared to the past. For example, if momentum is outperforming by a margin that has rarely been sustained before, it may suggest that risks are building in that part of the market. Hence, a contrarian investor should be cautious. Similarly, if value significantly outperforms over a sustained period, it may indicate a different phase of the cycle. When any one factor leads strongly, it tends to attract flows, valuations expand and expectations rise. The trend can continue, but the room for disappointment increases. When this gap begins to narrow after reaching extreme levels, leadership often rotates. Capital moves into other parts of the market. These indicators help us understand when one side of the market may be crowded.
Okay, understood.
We do not rely on a single indicator to form a market view. What matters is what a broad set of indicators is signaling collectively. If the majority point towards elevated optimism, a contrarian investor uses that as a reason for caution. If they point towards pessimism, that is often where opportunities lies for contrarian investor. We are not trying to forecast short-term market movements. we are trying to understand whether market is balanced or whether risk is becoming concentrated. When one factor dominates, cycles tend to evolve and leadership eventually shift.
So this is how we recognize where we are in the cycle, thus allowing investors to adjust exposure thoughtfully rather than react to market moves. Markets move in cycles. Understanding that cycle is what improves decision making over time.